You're getting calls from banks where they're like, hey, let me know what you think about this. Theoretically, if you took it over, what would you pay for it? The fact that the banks are now chumming the waters, so to speak, to figure out who's there tells you that a lot of them getting ready to step in and basically start to reposition assets.
I have the pleasure of speaking with Marcin Drozdz. Marcin is a managing partner of M1 Real Capital, where he and his team focus on acquiring value-add multifamily properties throughout the Southeast. And over the past 18 years, he has established himself as the go-to in world of capital raising and deal structuring. And he's sourced well into 9 figures of capital, private capital that is, to acquire over 1,600 units across the US and fund several different businesses. When he's not on the lookout for new opportunities, he is teaching up-and-coming real estate investors about how to raise capital, scale their business, and launch their fund. I'm really excited and pumped to have him on the show today to share his incredible knowledge. But enough out of me. Let's get him out here. Marcin, welcome to the show. How you doing today, mate?
Excellent. Appreciate you having me. Looking forward to it.
And for those listeners or for those people listening in and not watching online, where are you dialing in from right now? Not that you could even tell by your background, but where are you dialing in from?
Well, you can't tell this is Toronto, Canada?
No, I can't. If you had a big Canadian maple leaf in the background, I would have. Or Blue Jays or something like that. So Toronto, Canada. So you're an expat like myself, but you live obviously still in Canada. So we're going to have a lot of fun today talking about the differences of investing here in the US. And actually, my journey started with another Canadian, a good friend of mine, Scott Reese. Big shout out to Scott. He's in Vancouver, Canada, and he actually got me in the game of multifamily real estate way back in 2013. So we don't need to share that story, but if you've been listening to the podcast for many, many years, you'll understand that story. But Marcin, with that being said, let's rewind the clock and tell me how you made your first ever dollar as a kid.
So first dollar I made was picking up golf balls. And I picked up golf balls at a driving range. So you probably know the story. I used to have them. You'd whack a ball from a driving range, and then the golf ball picker would pick up most of them. But what would end up happening is a bunch of them would end up in the sand or whatever it was. So as kids, we're 10, 11, 12 years old, go out there in the evenings with milk crates, like those big milk crates, and you got paid $2 a crate. So you'd be out there running around, and eventually you'd figure out like systems. You'd have like hockey sticks to try to rakes and all this stuff. And yeah, it was interesting. You make 20, $30 a night. I mean, you were 10 years old, 12 years old, you're rich, right? So
that's awesome. Walk us through the journey of, your story, and was there a pre-real estate journey, corporate world, or was it just straight into it from the get-go?
So early days, I went to school. I thought I was going to become a lawyer. That was kind of what my family was directing me towards, especially my mom, because, Polish, Eastern European, you want to say that your son's a lawyer, an accountant, or a doctor or something like that, right? So I started down the path with school, but while I was doing that, I was buying properties on the side. So I read Rich Dad Poor Dad, bought a few of these courses, did some stuff, flipped a house or two, and then it was time to graduate, and I did an internship downtown, and I very quickly figured out I did not want to be in that world. So immediately ran for the exit, got into private equity, was lucky enough to get recruited into that space in my early 20s. I was 21, 22 years old. And, one thing led to another, got an opportunity to work under some really cool people, learned a lot of stuff, saw how big deals were made. You go from buying, your own little single family house or rental property to, okay, kid, we're buying this 200 unit building. And then we're buying another one next month, and then we're buying another one, right? So your mentality at that early age, how do you go back, right? So for me, that was just, I was hooked, hook, line, sinker. I worked there for a few years, raised a bunch of money, learned how to, put the deals together, the structure, the legal, all that stuff. And then, the world kind of broke, at 2010, 2011, I started building my own funds, and, fast forward a few decades later, a little bit of gray hair, and here we are.
Yeah. Well, who was the private equity firm that you worked for back in the day?
Oh, it was a family office. It was FT Capital. It was a family office.
And were they buying US based assets at the time?
Oh yeah. They were buying US based apartment buildings. They were partnering with a guy named Ken McElroy. So if you know Ken McElroy, MC Companies. So Ken at the time, back 07, 08, was about a couple hundred. He was probably $500 million at the time, which is still pretty good size. especially for those standards. So when our firm hooked up with them, we were providing a good chunk of the equity.
Gotcha. And that would have been early days. You said 08, 09. So was that before the crash or just as the crash was happening?
So it was right. It was so funny that you asked that. So I literally get recruited. I get hired. I move out west. I turn my whole life upside down, and I was sitting in the office and I'm looking at the screen, and Lehman Brothers just laid everyone off, and they're walking everybody out with the banker boxes. Like, that was ingrained in my brain. And I'm sitting there, and I remember my mom calling me. She's like, "So how's it going?" I'm like, "It's great." Because the market just crashed, right? So right in the midst of it.
Gotcha. And I know that we want to dive into the similarities of that time versus today. I wasn't around actively buying back then, but it definitely has the hallmarks if you start looking at history and reading. What was, as we sort of, your ventures into today and what you're building, maybe give the snapshot of the portfolio and what you do in 2024.
Sure. So when COVID hit, we were lucky because we were mostly cash at that point. I mean, we did buy some stuff into COVID, and we had a couple hundred doors that we were liquidating during that process. But what had happened was, like yourself, you're at home, and they were telling us to flatten the curve or whatever story we were all being told, to stay home and eat bonbons for a few months, right? So I'm at home kind of crawling up the walls, and at the same time I've got people calling me and asking me about deal structuring. Hey, I'm working on this, I'm working on that, and calls that I normally didn't have the time for, I now had the time for. So I literally started walking people through deals, through transactions. And that's literally during COVID when I started to, make the most of what I had in my head. And I started writing out all the systems and the processes, which ended up becoming, the mentorship side that we do on the capital raising business, because it was like, you never had the time to just sit there and sit with your thoughts for a little bit, but COVID allowed me to do that. So that's been fantastic. Since then, we've bought a few more buildings. We just bought 144 units in Houston, Texas. So I really like the Texas story, probably for the same reason you do. And, going forward, I think there's going to be, Mark Twain says, he goes, history doesn't repeat itself, but it sure does rhyme. And I think with what's happening today, where we're seeing just a serious crisis in confidence in the markets, there's a lot of parallels between that today and what I was seeing, maybe inadvertently back then in 2009, 010, 11.
Well, let's talk about it. What did you see? What are the sort of, 3 to 5 things that you can say, aha, looking back, that happened exactly the same as what is happening now?
Sure. So the first thing was, people were throwing money out like it was going to expire. Like, literally, if you're not going to spend it, it's going to expire. Like, that was the mentality people had back then. People were refining their houses back then, like ATMs. They were doing all the things that they were doing back then. And we all saw this. Today, or not today, but pre-interest rates being raised, it was getting real crazy as well. You saw people buying boats. Like, I had friends that bought boats for $50,000 who sold them, flipped them 3 months later for $90,000. I had friends buying trucks and like, you just see people speculate. Rolexes, instead of 25 grand from the dealer, people are paying 45 grand on the street. Just so much speculation in the market. The cryptocurrency industry, whether you think that's real or speculation, the point is the prices went nuts, and there was just so much money being thrown at things. And I think it was because, one, all the stimulus that was out there, but two is the interest rates. So it was literally the same thing back then. Mind you, it was different because it was driven by the residential consumer in the asset prices. Today, it was mostly driven on the commercial side, which, as I was talking to Ken McRoy, I did a podcast with him a while ago. He was talking about how all those people on the commercial side, they think it doesn't impact them on the residential side. But the truth is, all of our pensions, especially the employees, all the employment pensions, where do you think they're invested? They're invested in those commercial assets. So, it's a different, it looks like a different problem today, but it all comes back to the same thing. There's a massive systemic crisis in confidence. And, raising money today, I mean, I don't know if you guys are noticing it, but it's a different game to raise money today than it was even 24 months ago.
100%. Let's dive a little bit deeper into that on the confidence side, but what you said on the pensions, because my perspective, again, I wasn't around in 2008, but I started in 2013, 14. If you look back at also what happened at that time and why there was a lot of money in commercial real estate, the Jobs Act in 2012, like that had a huge impact on how people can access deals and advertise deals. And if you remember, there was also a lot of crowdfunding, right? It was cruising the internet, but real estate's still very mano a mano. You're not just going to chuck $100,000 in, a deal you see online at 10 o'clock at night. But that was the intention, right? That was the thought. But then also coupled with, and I'd love your perspective on this, the crash of '08. But then the sort of demystification of commercial real estate as an alternative asset and seeing these bigger players like the pension funds and all that sort of stuff start to put money, and they may have historically done it, but it seems like there's a lot more people in the lane today or over the last decade, which help create a frenzy coupled with lower interest rates. And then obviously you've got, the pandemic that happened towards the tail end. But in my opinion, it sort of started with that 2012 timeframe of how you could raise money, the access to deals. And I just, again, would love your opinion on what, if you thought that has had any effect on where we sit today in a very, very crowded lane of particularly in the multifamily space.
So the Jobs Act definitely did democratize investing, and that's kind of a gift and a curse all at the same time. And what I mean by that is because it became so much easier for people to invest in what were historically alternative assets, two things ended up happening. A lot of good happened in the marketplace where people did do good deals and create billions of dollars of net worth and value for other people. But at the same time, what ended up happening is there's always two sides to a coin. There's people that are going to take it for the right reasons. There's going to be other people that are going to look at that and go, oh, there's some fees here for us, right? So unfortunately, and we've seen this in Canada, I'm sure it's been in other parts of the world, where whenever you open up the market on a capital raising standpoint, you end up getting the good and you end up getting some unintended, consequences. So the Jobs Act, I remember reading it and looking into it, and I thought to myself, okay, this is going to go either really well or it's going to go not so well. And what's the saying is, you can be the good, you can start out as the hero, but if you live long enough, you become the enemy, right? So you live long enough to become the villain, right? So I think we're starting to see some of that stuff in this market space where some people are becoming vilified. And look, some maybe did things maliciously, but a lot of people, I just think they got caught up in enthusiasm, which brings me to my second point, which is when you have retail capital being able to get into something kind of totally open borders, so to speak, then what ends up happening is you drive up things beyond what the smart money would have naturally driven those things up to. So, what percentage of that caused the corrections that are happening in commercial here? I don't know what those numbers are, but the thing that's always been interesting to me is that the money that's raised through these alternative channels is a minnow compared to the killer whales that actually run the real money, like KKR, Blackstone, Apollo, Fortress Investment Group out of New York. Like these are multi-billion-dollar conglomerates. And when they move into a sector like build to rent, or when they move into an industry or a market, or, in Texas, you see where they go into certain areas, Austin or otherwise, when they go in, they don't just go in with 50 million, they go in with 500 million, they go in with $1 billion, they go in with a couple billion. So that moves the whole market, I think, a lot more than just few guys like you and me raising, $50 million or $100 million or $200 million and, buying a few buildings. But did it move the needle? Yeah, it did. And, the other thing too, is it probably took some risk off the institutional guys, because I know guys that have sold to those, that have bought from those guys, and they've taken the risk off that.
I think as you tie it back into today's run up in interest rates, there's a lot of both smart money, as you said, and unsophisticated money that made mistakes, right? And you can't just say it's all one side or the other. A lot of people made bets on the lending side. We had then too much stimulus in the economy, and you got to now deal with inflation, and thus right or wrong, Mr. J Money Powell has increased interest rates 500% in a very short period of time. Asset values will go down, and everyone who thought they were the smartest person in the room across the board are now looking at potential big losses because asset values are not what they were, 2 years ago.
So I'll give you a practical example. So I'm Polish. I was born in Poland. I came over to North America when I was really young, and I remember going back to Poland when I was I think it was 7, 8 years old, and it was in the late 80s, early 90s. And shortly after, when I was there, my grandma gave me $1 million bill. I've told this story a few times. She gave me $1 million bill, and I'm like, $1 million, like grandma's loaded, right? So I go to the grocery store and I'm excited to pick up some. I thought I would buy the whole store, right? And I walk out with like a bag of chips and like a Coke, and I get like 300 grand change or whatever it was. So what had happened was that was the old Polish dollar, the zloty. When it got converted, when they did a rollback, they did a redenomination or renumeration of the currency, redenomination of the currency. They did a 10,000 to 1 rollback. So what was 100,000? What was 1 million became 10,000. So here's why that matters, because Poland, like so many other countries, Argentina, all these other countries in the world, they print money into existence. And then when they do a rollback, everybody holding cash gets wiped out. The people that would have done well during that situation, whether it's in Poland or any other inflationary market, were the people that had real assets, real estate, apartment buildings, businesses. And it's not just because it's real, but because the debt that was tied to it also got rolled back because it was also denominated in the same currency that the paper was. Do you know what I mean?
Yeah.
So but the bricks are still there. The asset is still there. And, whatever version of that we're going into now in the US, I mean, in hindsight, it should have been obvious that the interest rates were going to go up. But I think people at this point were just hoping that the party wouldn't stop.
There's so many lessons to learn. I remember walking around the halls of a very big real estate, syndication, and just thinking, gosh, there's so many people here, right? And
right. Overhead.
2 or 3 years ago, that conference wasn't even in existence. All of a sudden, 2 years later, you have thousands of people attending, and there's just a part of me that was like, what's going to go wrong here? I didn't know what was going to go wrong, but this couldn't go on forever. So back to your point of your explanation of the $1 million bill, do you think that the flight to real assets today will create a floor for pricing here in the US as you start to see, and are you seeing deals starting to come back to market? You mentioned you've got 144 units in Houston.
So I'll give you an example. Okay, practically speaking, that building I bought it for approximately half of a replacement cost. Now, I would have never historically bragged about that as a metric, but today it's valuable. The reason for it is because cost to build has gone up so much ever since COVID, that everything that's standing in good shape is now naturally more valuable because replacing it is going to become that much more expensive. So literally, I bought it, renovated. I'm still, I think, 60% of cost to build. So it's like, okay, why is that valuable? Well, as long as you're in a market where there's employment and demand and all that stuff, there's always going to be people that are going to want to live there. So the guy that's going to build next to me or across the street or whatever is immediately going to have to contend with a 30 to 40% headwind just on the build. And that's a big deal today. And my point is this: 10 years ago, that wouldn't have been the major thing that I would have talked about. But today, that is such a big thing because of the price of lumber, the price of labor, the cost of all these things, right? These are big factors. Now, and then to answer your question or to comment on your thing directly here, I think it's super possible that we're going to see a market where everything is, 3% or 30% more than what it is, or 300% more than what it is now in paper, but we're all making more money. So everybody's a millionaire on paper, but a cup of coffee is $37 as an example. Do you know what I mean? Like, I don't know if this is going to be 5 years or 3 years or 10, but I think we're going in that direction. And, again, taking the example of other countries, I mean, whether it was Poland or Russia or other parts of the world were just printing money and they tried to raise interest rate, all that happens is they just print more money faster to keep up with it. And the US is doing the same thing. The national debt keeps going up, not down.
Mm-hmm. Yeah, no, it's I'm not an economist, but yeah, it's interesting how as you take those third world or developing countries and you look at the value of, you travel to any third world country and you're like, that $1 gets you 10,000 whatever it is, pesos or rubles, or insert it's the devaluation of a currency. No, it's super interesting. So now let's bring it all back. Like, what do you,
Sure.
besides this, your statement you just made of things being worth more and everyone's, or everything's going to go up, cost of living, coffees to employment. What other things are you predicting coming into the next sort of 3 to 5 years? And do you think now is a good time to be buying?
So first of all, it's always a good time to buy for the right price, right? That's the thing that we can't agree on today yet with buyers and sellers is what the price is worth. And I think, given a long enough time frame, the buyers are always going to win because they can afford to wait and the sellers can't. So what do I mean by that? In the market today, and you've probably seen the stats as well as I have, a lot of the loans that are coming due right now. There's a lot of bankers making phone calls where they have clients that they know they're done. Like, they're one step away from getting the keys back on thousands of doors, literally thousands of doors across the US, not just Florida, not just Texas, not just LA, like just everywhere, like across the entire, good chunk of the US. So what does that mean? Well, it means that ultimately the banks are going to be the ones with the problem. And the thing about the banks is a lot of the banks, they all have rules and regulations around when they have to write off their loans. So they can only pretend and extend for so long until somebody from the compliance department is going to show up and say, hey, what's going on with this loan? Oh, when was the last time they paid? Oh, 6 months ago. Oh, 12 months ago. Okay, cool. You have 30 days. Get it off the books. And I don't know if I've seen a lot of that yet, but when that starts happening, that's when you're going to really start seeing the sellers, because at that point, the banks are just going to basically push the sellers aside and be like, hey, this is being sold. Your equity's out. And we're literally starting to get those calls where, you're getting calls from banks where they're like, hey, let me know what you think about this. Theoretically, if you took it over, what would you pay for it? And the fact that the banks are now chumming the waters, so to speak, to figure out who's there tells you that a lot of them getting ready to step in and basically start to reposition assets.
Yeah, no, I completely agree that the last 6 months have been a lot of, hey, this price discovery to what you're saying, but then it's less than what the bank note is on the property, and 100%. The banks are saying we're not doing short sales. There's only a finite period of time you can say that before the music stops.
Yeah, they're gonna try to hold the line for as long as they can, but what's going to end up happening is they're going to realize, I think, like everybody else, I think they're hoping that the Fed's going to bail them out, and they're going to come around and say, hey, just kidding, rates are back at 1% or rates are at 2% or whatever it is. But we're not seeing that. And I don't think we're going to see it. I mean, people think rates are high now. They're not high. They're just where they used to be. Right. Like buying a 7 cap or 8 cap was normal. Buying a 9 cap was normal. I mean, I remember when, 10 cap was like, you were looking for 8, 9, 10 caps because rates were 6, 7. Like this is all normal. And the problem is the sellers are not cluing in. And the buyers are just sitting there, and they're even the people that want to buy, it's not penciling. So what are they doing?
Yep. Well, and to that point, the lenders also got to come to the table, right? It's back to my statement earlier. Like, it's not just the buyers who made the bad decisions. It's also the lending. The lenders lent at that time and now have things on the books that are worth less than what the loan is. And I am seeing a couple of REOs starting to hit the market right now in certain markets that I think is a very good time to be buying. But to your point of replacement costs, like, we're picking up 176 units in San Antonio, Texas, and I'm buying it at $105 a square foot. You can't build that, on 17 acres where, the average unit per acre is less than 6. Like, it's, you just, to replace that exact product, you'd be spending $250 a square foot right today on a 2 to 3 story garden style apartment. It is what everyone's talking about. So if you're an active investor out there listening to that, I really understand what you're picking up, what it is a replacement cost of going in assets today. There is an argument around, well, yes, it's an 80s vintage or 70s vintage versus a 2023 vintage, but to rip it down and start again, there is some validity to shoring up your bets in terms of a safer bet in an investment in a deal that is in a good, well-located area that people are still going to want to need a roof over their head for the foreseeable future.
There's also a big gap in the market for construction. So I was talking to Ken McRae about this, and he was walking me through the graph where the construction had kind of fallen off a cliff during the early 2010s and didn't really pick up till the mid 2010s. And that 4 or 5 year period, that was a gap in the marketplace. We never recovered that. That was never built. So it's not like it was tagged on later and built. So as more product continues to age and get torn down or whatever it is, we never replaced that product. And there's about a 5 million housing unit gap that was never replaced. So on top of today, prices being where they're at, rents being where they're at, affordability being squeezed, we actually don't currently have a way to replace that inventory. And that is the problem. So, I'm seeing a lot of guys that are right now literally picking up the newer product, and they're doing it with the intention, knowing that they're not going to make as much money today on that product, but they're banking on because there's a lot of housing that hit the market earlier this year and late last year. There was kind of a post-COVID kind of build out that just kind of finished. And they're betting on the fact, really smart guys, they're betting on the fact that in a year to 2 years, when it finally hits the market and vacancy rates just get destroyed because there's nowhere to live, that all of a sudden, all that stuff they picked up at par today is going to become incredibly valuable. So that's an interesting outlook too.
Interesting outlook. I also hope it's not grasping at straws, again, to justify values of what people, and to justify the pretend and extend or whatever that might be that's going on in someone's portfolio. Because look, if you've been active in the last 2 or 3 years, you're going to have assets on your books that are worth less than what they were when they picked them up. That's just the fact of the matter. And it's not necessarily anyone's fault, but you do have to deal with it. And it's dealing with it from investor levels from LPs all the way through to lenders as well, and everyone coming to an understanding or the reckoning of we may have to part ways here, and there is blood in the street. If there isn't now, I believe there is now. I don't think it's quote unquote coming. I think there's already blood today if you're looking in the right places. So I think it's a great time to be buying if you're at cap rate expansions to debt that makes sense. So yeah. Marcin, what do you got planned for the rest of 2024 and beyond as we come to wrap up the show here?
So we're currently working on launching actual distress fund. In the process of it, because like I said, I don't have a crystal ball, but whether it's going to be later this year or early next year, I think there's going to be a lot of activity in the market. We're mainly focusing on that $25 to $50 million deal size, because in my experience, that's going to be too small for the big boys that are going to come to, because look, the big shops out there, they're looking 50 million for them as a rounding error. So, I don't want to be one of 8 people trying to buy a $50 million asset. I'd rather be the only guy at the table to buy a $19 million asset that I can pick up for 11 as an example. So, somewhere in that range, or you know what I'm saying, that's the thesis that I think we're really bullish on, and again, there's going to be the big thing that I think a lot of people are going to have to go through the first time, unfortunately, is what happens when your NAV gets wiped out on paper, and those same investors have to have the confidence to go back into the marketplace. So, are you going to be able to show them that A, what you've already done is going to make it through, and B, can you demonstrate to them that this is the right time to buy? Because, what's the saying, buy when there's blood in the street. Well, the second part to that is even if it's your own blood.
Right.
So that I think is going to be the theme for the rest of this year and probably next year.
Yep, I love it. Mate, at the end of every show, we like to dive into the top 5 investing tips. You ready to get into it?
Let's do it.
Mate, question number 1, what is a daily habit you practice to keep on track towards your goals?
I was going to make a joke and ask my wife, but I think she'll tell me what my goals are that day. But no, I think the sincere answer is to just sit in the morning, kind of just sit quietly with myself for 5 or 10 minutes before flip the monitor on, flip the screen on, and just kind of reflect on what that big thing is today. Because you know how it is. You can have 20 things to do you want to do in a day, but what is that one or two things that you have to get done?
Question number 2 is, who's been the most influential person in your career to date?
Most influential person. So the person that comes front of mind right now, in my mind, just because I was reading his book recently, is Ryan Holiday. I don't personally know him, but he's an author. He wrote a book called The Obstacle is the Way. What's in the way becomes the way. So that's been very influential. And, by extension, Marcus Aurelius. He's the guy who's kind of one of the godfathers of Stoicism, so to speak.
Yep, Ego is the Enemy is another great book from Ryan. So if you ever check out Ryan's books, he's fantastic author. Question number 3 is, what's the most influential tool in your business? Now, when I say tool, it could be a physical tool like a journal or a phone, or it's a piece of software that you just can't run the business without. What is it?
That's a great question. Most influential tool for me, I think, is that's my ability to be quiet. And what I mean by that is silence is a tool for me, because I naturally prefer to lead conversations and engage and things like that. But I find, especially internally, whether it's personally or professionally, if I can be silent and just ask really good questions, I typically get a lot more out of the conversation.
That's a very good piece of advice. I think we all need to be a little bit more silent. That's a great piece of advice. Question number 4 is, in one sentence, what's been the biggest failure in your career, and what did you learn from that failure?
Biggest failure for me, the one that's most meaningful to me is, I guess it's a consistent theme, is when you plan too far ahead in life, thinking that you're somehow in charge of what's going to happen along the way. So, and I say that tongue in cheek because I could apply that to making plans for a weekend, hour by hour, or to a business. And in both cases, it kicks you in the ass, because if what's the joke? Man plans and God laughs, right? So man makes plans and God laughs, right? Like there's nothing wrong with having like plans, but the way I planned it is as if I knew what the like outcome would be on a daily basis. And for me, every time I do that, I end up, you just end up setting up yourself for disappointment.
Yeah, that's a very good question. I've always been the one to like let go of your 10-year targets and just like focus on what you can control, the doors you can open today, and that the 10 years will figure it out itself. There's so many people like, I need to be here by the time I'm 45. It's like, it maybe have a goal or a direction, but I don't know if you're going to really get there, because you got to also be nimble enough to change and pivot as outside forces may force you. So I love that, man.
100%.
Last question. Where can people reach you to continue the conversation that'll be in your sphere? Where do they go?
Sure. Yeah. Best place is my website, marcindrozdz.com. Check it out there. There's resources. There's all kinds of things people can learn about myself, my story, books, that kind of stuff.
And can you just spell the last name for everyone?
Sure. It's DROZDZ.
Well, Marcin, I want to thank you so much for coming on today's show. Really insightful conversation around, I could talk to you for hours, really, because of your experience in comparing the parallels between 2008 and today, and looking back at, even in myself and my own investing career, like thinking about like what's going on right now in those sort of frothy times, and being diligent. But also then what's the reckoning that's coming right now, and how do you continue to invest money in today's market has been really, really valuable for, I think, the listeners and for myself, taking that away from today's show to understand, you're still going to be prudent with what you do. There's still going to be times people are still going to need a roof over their head. There will be a lull, even though you might think that vacancies are through the roof and rent rates are low, but there will be a lull with the fact that the constructions are coming to a slow, and the cost of labor is also continuing to increase. But also then there's some really cool things you just said at the end there. The silence is a tool. I think I've never had anyone tell me that silence is a tool. It's a very powerful thing to sit with your own thoughts before you speak, and is a hard muscle to exercise in times when you want to jump into the conversation. So did you leave anything out?
No, I think a good parting comment for everybody, a mentor shared this with me, I'll share it with you, is it's not about return on capital until you know how you're going to see return of capital. And that's probably a really, really important thought to keep front row center today, because the smartest people I know, the wealthiest people I know, don't care about how much they can make. until they know how much they could potentially lose. And once they fully understand the risk, then the return potential is in the context of that.
I completely love it. Well, mate, thank you so much for jumping on today's show. Enjoy the rest of your week and weekend, and we'll catch up very, very soon.
That was cool. Appreciate you.
Well, there you have another cracking episode jam-packed with some incredible advice from Marcin. Remember to go check him out at his personal website. You can Google his name anyway, and he'll come up online. If you do like this show, the easiest way to give back is to give it a 5-star review on iTunes. You can get all the show notes from today's show on my website at readgoossens.com. We're going to do this all again next week. So remember, be bold, be brave, and go give life a crack.